So welcome to Northland's The Artisan Podcast, where we share insights into investing by hosting some of the world's top investors and their advisors. So this morning, we'll be exploring the topic, will the Fed or the Bank of Canada ever be able to raise interest rates? With our special guest speaker, Alpine Macro's Chief U.S. Bond Strategist, Mark McClellan. Now, Mark is Alpine Macro's Chief U.S. Bond Strategist, and prior to joining Alpine Macro, he was the Senior Vice President and held numerous key positions at his 23-year career at Bank Credit Analyst Research, including Chief Global Fixed Income Strategist. He was instrumental in developing and directing several fixed income publications, including the BCA Global Fixed Income Strategy and the U.S. Bond Strategy Services. Mark also covered the U.S. Asset Allocation, where he headed the U.S. Investment Strategy Service, as well as BCA's centerpiece publication, the monthly Bank Credit Analyst. Mark began his career as an economist and as a macro forecaster at the Bank of Canada, and holds an MA in economics from Western University and a BA in economics from McMaster University. So good morning, Mark. Right out of the hopper. So you worked at the Bank of Canada with Stephen Poloz, who was the former chief of the Bank of Canada. How do you make sense of the current monetary policy with negative interest rates and massive money printing for the average Canadian?
All right. Well, good morning, Arthur. And it's a pleasure. Thanks for having me as part of your podcast today. So for this question, going way back to the early 1980s when I was doing my bachelor's degree, taking Economics 101, in that textbook, they told you that monetary financing of government deficits is bad because it's inflationary, full stop. Nobody debated or countered that point. You know, it was just a fact of life. So there's going to be consequences down the road for this kind of action. But today we seem to be stuck in what's called a secular stagnation, a term that's been made popularized recently by Larry Summers, a famous economist. And it's a world characterized by low economic growth, poor demographics, low productivity growth, and also weak capital spending by the business sector. And on top of all that, you've also got a real desire to save in many countries in the household sector. So we call it the excess saving story. And this has made life difficult for central banks in a couple of different ways. First, the flip side of that excess saving story is deficient private sector demand. And so that has led to pockets of deflation and low inflation overall. Central banks around the world have had a hard time getting inflation up toward their targets of 2%. So that's the first problem. The second problem, and it's related to the first, is this idea that the neutral level of the central bank rate is very, very depressed. So I won't get too technical, but basically the neutral level is the Bank of Canada rate is the level at which, above, if the actual Bank of Canada rate is above that level, it's restrictive for the economy. And if it's below that neutral level, it's stimulating the economy. And so it's a theoretical concept, but one that's quite useful. And the problem is that the excess savings glut and this inflation being so low and below target is that it's pushed down that neutral rate down towards zero. So it's made it more difficult for central banks to stimulate the economy because they have less room below that level, because they have to push the interest rate below that neutral level to stimulate the economy and getting it going. But when it's down close to zero, well, they have the zero bound problem where they're limited as to how much they can cut rates below that level. So you get into, they're worried about getting into sort of like a catch-22 where low inflation reduces that neutral rate, making it difficult for central banks to stimulate the economy to get inflation up. And so inflation then, falls short of the 2% target even more, and you get into this kind of vicious circle. So that's why central banks have really, in recent years, pulled out all the stops in order to try to get inflation up toward their target, including what we call quantitative easing, just the massive purchases of government debt to try to stimulate the economy that way by pushing down the long end of the yield curve, making it cheaper to borrow. So that kind of brings us to where we are now. That's why they've been so aggressive. But the thing is, we're running a grand macro experiment that we've never really done before, and nobody knows how this is all going to play out in the coming years. So it's very, very foggy, sort of long run outlook.
Now your firm has come out with a very thought-provoking piece that it's unlikely that the Fed will be unable to raise interest rates. What happens if the Fed did raise interest rates, and what do you think happens if they don't? It seems there's a lot of fog around this because the last time I was around rising interest rates was the late 80s, and it seemed to really cool off the economy.
Right. Well, the pandemic, as you know, has changed the economy in many ways. But at Alpine Macro, we think that the excess savings story and the deficient demand story, that backdrop has not really been fundamentally changed by the pandemic. There's probably no real change in underlying productivity growth. The demographics are the same. It doesn't look like there's any huge spurt in business capital spending. So we're still in that world, that secular stagnation world. It's kind of being masked right now by massive fiscal stimulus and then the bounce back from the pandemic recession. It's masked by that, but underlying it is still these macro fundamentals that are still operating in the background. Inflation, we're seeing higher inflation readings in Canada and the U.S. and around the world because of these supply bottlenecks mostly. And we don't think that's going to last. That's not the new normal. For example, in semiconductors, there are shortages there that everybody's well aware of. But those supply disruptions are going to work themselves out over time. And so inflation is probably going to come right back down pretty soon and drop back below that 2% target that a lot of central banks have at the moment. And in the U.S., those stimulus checks that they've been mailing out, some states have already stopped them. I think for almost all states by September they're done. So those industries that have been having a hard time hiring people and have had to boost wages because they just can't get workers in the door, like in the leisure, especially in the leisure sector, like restaurant, hotels, and things like that. There's been some upward pressure on wage inflation, but those people in the fall are going to have to go back to work once those stimulus checks end. And so we'll see that little spurt in wage inflation come back down. So the bottom line is that we think that neutral interest rate that I talked about earlier is still very low. It hasn't gone up. Hasn't really been changed by the pandemic. And central banks will try to raise rates here and there, but they'll probably be forced before long to reverse course. So we've seen this time and time again since the great financial crisis. Whenever central banks try to take their foot off the accelerator, you tend to get a negative reaction in equity, in risky assets and in the economy. And enough of a negative reaction in both of those that the central banks have to back away and in some cases reverse. So if they have raised rates, they have to back off and cut rates again. Now we've got in the U.S., the Biden administration is trying to push through some very large spending programs, like trillions and trillions of dollars. But the thing is, you got to remember that those are stretched out over 10 years. And they're not starting right away, and so they're not going to offset to any great extent that fiscal drag that's coming. So when those stimulus checks end, the fiscal stimulus then turns into a fiscal drag, and it becomes a drag on the economy for a while, and that's not going to be offset by the infrastructure spending, even if the Biden administration manages to get it through. In recent weeks, we've seen commodity correction. We've seen some volatility in stocks. The media is blaming it on COVID-related concerns, the Delta virus and all that. But I think that, and that's, I'm sure, playing a role. But I think also the market is beginning to sniff out this story that I've been telling you, that the backdrop really hasn't changed in terms of, we still have too much savings, not enough private sector demand, and that we're returning to that. We're on our way to returning to that world, and that's being reflected in financial markets. We've seen, the Treasury curve bull flatten quite a bit over the last month or so. So returning again, like I said, returning to that pre-pandemic kind of secular stagnation world where interest rates have to stay low. So that's the main reason why we think the central banks are going to have a difficult time raising interest rates over the next few years.
Do you think it's going to be forever, though? Is this something where this is maybe a 2 to 3 year outlook? Or what happens 5, 7, 10 or even 15 years out? I mean, all of us, we've been in the markets now probably 3 decades or longer. We've seen, declining interest rates more or less year over year during those periods. Is this an apex moment? Could this be a slow increase over time? What do you think, Joe? I don't know. Do you disagree or maybe agree with Mark on this?
I mean, it's a little bit unusual, but I think on this issue, I'm more in line with the consensus. What you tend to see is after long periods of a certain trend, policymakers will fight the last war. I think that's exactly what's happening right now. So if you compare the reaction to the pandemic versus the great financial crisis, the monetary response was the same, just as big. The fiscal response was as big or bigger, and there's more to come. But if you look at the underlying economic structural issue, the pandemic, as Alpine has argued correctly, is much less than the great financial crisis. I don't think we're looking at 10 years of deleveraging. In response to this, it's an economic shock that gets done actually rather quickly. And then if we look at the underlying, it seems like policymakers are a lot more aligned with labor than capital, as they had been over the previous 30 years. We look at minimum wage increase, and if we look at the underlying world, it's at least somewhat more inflationary. Globalization peaked over a decade ago. So these real deflationary forces are weaker now. Since there's less competition, it's unclear how the labor market is going to play out in reaction to the pandemic, how long-lasting, either the power of labor is or the power of capital in response to work from home, etc. But what we're seeing right now is, one of Greenspan's favorite measures, job leavers as a percentage of employment is at a multi-decade high. So it appears that at least in the near term, labor has some power. We're all seeing this anecdotal. Restaurant can't find workers because they're in construction or what have you. And that's also very true, of white collar. So I'm more along with consensus that I do think the Fed will be able to raise rates, and that will allow the Bank of Canada follow suit. But it's going to take a really long time because the Fed has a dual mandate, both inflation and employment. I think inflation will come off. I think growth is slowing. Mark's absolutely right here. But on the employment side, it's going to take quite some time until we're at full employment. So I think there are some structural changes at the margin, but I think we both agree it will be quite some time until the Fed can raise rates.
That's great on that aspect. What do you think? Do you want to counter on that, Mark?
Yeah, I mean the inflationary backdrop in the next 6 months to a year is highly up in the air. I wouldn't argue vehemently with Joe on that. looking further out, if you look at what's driving the secular stagnation story that Larry Summers talked about, and what has changed, what could change that in the future. The demographics aren't going to improve much unless Canada and the U.S. lets in a lot more immigrants. Let's say the labor force growth is probably going to stay quite low. On the productivity side, you could tell a story where climate change forces a lot of investment by the private sector, and then you add on top of that extra government spending to fight climate change as well. You could see investment spending as a share of GDP rise quite a bit. Now this is a long-term story. It's not going to happen next year or anything like that. And typically more private sector investment leads to a faster rate of productivity growth for the overall economy. So these two things would help to mitigate the secular stagnation story that Larry Summers talked about. So the silver lining, if there is one, for climate change is that, like I said, it might force a lot more innovation and investment in new technologies.
Now, previously on one of your answers, Mark, you were talking about quantitative easing and the Federal Reserve buying bonds that are issued to the market. Is this something that can be reduced over time or tapered? And if so, or maybe they stop buying bonds, what happens to the bond market if the Fed steps out of the way?
Yeah, we do think that the Fed is going to announce, before year end, a tapering program that will probably start early next year. They see the economy as probably strong enough to handle, a pullback in that area. And they're going to proceed quite slowly with this. They're nervous about a repeat of 2013, the last time they announced a tapering, because the bond market sold off. There was heavy risk off in financial markets at that time. The Fed is going to try very hard to convince us that, look, this time tapering does not mean tightening. So rate hikes are not right around the corner just because we're stopping asset purchases now. And maybe markets will believe it this time because, we've been through this now once before. In 2013, actually, the taper tantrum came because it was a surprise. The Fed didn't really give us much heads up that this was coming out. And then Ben Bernanke, at the time the Fed chairman, kind of shocked the market with this announcement. This time it's well discounted, I think. But nobody knows for sure. Investors still could take the announcement poorly if it happens in the context of, let's say, the U.S. economy, growth disappointing to the downside, not a recession, but just slower than expected growth. China's been slowing as well. Markets might see it as a bit of a policy mistake, that the Fed's tightening just at the wrong time, and then you get a risk-off phase. And that negative reaction and probably a rise in the U.S. dollar associated with that would probably cause the Fed to then back away, or at least, calm down its rhetoric in terms of tightening policy, talk a bit more dovishly, and then that might be enough to get risk assets moving up again. But you won't see that unless you have a reaction in financial markets in the first place. So this is one of the reasons why Alpine Macro has become more cautious for the near term, or at least between now and the end of the year, because of this potential for sort of a mini taper tantrum.
And taper tantrums basically mean that the pricing or the value of publicly traded debt tends to decline as it's repriced into higher interest rates. Now, Joe, is there a way to deal with that, either publicly or privately, to either hedge that risk or to take it off the table somewhat?
Well, first of all, to begin, I would concur with Mark's statement in terms of tapering. I think that they'll be very slow. They'll try and telegraph things as much as possible. And I think a lot of that transition, has been discounted. given risky asset yields in public markets of 2 or 3%, I think that there's asymmetric risk in those sorts of bonds. The same is not true, on the private side, where your beginning yield is 10, 11, 12%. And to be honest, the default rates historically have been less than the public debt, which is currently yielding 2 or 3%, and you're getting much better collateral value. In addition, there are certain specialty hedge funds that can limit your downside risk through either trading the option curve or having things like knockout options. So we will tend to put a small percentage of assets in these sorts of specialty funds, because what we want to do as a total portfolio is limit downside risk. So if 95% of the portfolio does well in good times, in bad times we'll try and have 2, 3, 5% that can go up quite substantially and offset any risk.
No, that's great, Joe. So Mark, we've been talking about the Fed, but the Bank of Canada is not the Fed. Canada is not the United States. Is our Bank of Canada independent? Like, can it look and see what's going on south of the border and say we're going to come to our own conclusion? And how would the Bank of Canada respond to the Fed tapering?
Well, the Fed tapering, if it leads to a risk off, could truncate or at least delay Bank of Canada rate hikes. But sort of starting at the beginning for Canada, some of the same things things in the macro backdrop I talked about for the U.S. in terms of the secular stagnation and the excess savings story. A lot of those apply to Canada as well, and a lot of people, including ourselves, think that the neutral Bank of Canada rate is also very low, and so they're in kind of the same boat as the U.S. and the ECB. Most central banks have this zero-bound problem, but I think there are some key differences between Canada and the U.S. The first one is that I think there's less slack in the labor market. So right now, I think that the number of payrolls in Canada is about 300,000 short of the pre-pandemic high. So as a ratio to the size of the economy, there's a bit more, there's less slack in Canada than there is in for example, in the United States. Secondly, the Bank of Canada has expressed concern many times about the housing market, those runaway prices to the upside, and all the debt associated with those high prices. They certainly like to see that cool off. And the other thing is that the Bank of Canada has not changed its policy framework, unlike the Fed. So the Fed has this new framework where instead of just targeting 2% inflation, it's targeting above 2% for a while to offset the fact that they've been below 2% for so long. So it's sort of a make-up policy. So if you undershoot your target for a long time, then you want to overshoot it for a while in order to kind of make up for lost ground. The Bank of Canada does not have that. It's not targeting that. I don't think the Bank of Canada would mind a little overshoot of inflation, but it's definitely not targeting that. So Bank of Canada is in a position to begin hiking rates before the Fed, I think, and they've already begun to taper, as you know, and they'll probably be done buying assets by the end of this year, and then or early next year, and then the first rate hike coming perhaps in the second half of next year in Canada, which we think would be before the Fed, because we think the Fed is more a year later in 2023 before they'll be in any position to hike interest rates. Now, is there a constraint? Well, if the Bank of Canada moves ahead of the Fed, then you get this interest rate gap opening up, and that makes Canadian fixed income assets look a little bit more attractive, and so it puts upward pressure on the Canadian dollar. So to that extent, the Bank of Canada is a little bit restricted in the sense that it can't raise rates extremely. If the Fed is on hold and the Bank of Canada is raising rates and the Canadian dollar is shooting through the roof, then that kind of limits how, to the extent to which they can raise rates, because it might be really undermining the Canadian export sector. So to answer your question, yeah, what it means for Canada is that if rates are going to stay low in the U.S., then limited upside for Canada as well. And then you layer on top of that the fact that our neutral rate is probably also very low. So that's, again, another limiting factor for how much the Bank of Canada can raise rates. But anyway, it's a bullish story for the Canadian dollar, but the problem is this risk that I talked about earlier, that the Fed starts the tapering. It's interpreted as a policy mistake. There's a risk-off phase, and in a risk-off phase, then the U.S. dollar would normally go up, Canadian dollar would normally go down. So we're not, even though we have this view on the Bank of Canada, we're not recommending long positions in the C dollar just yet. We want to, because of this risk. Once we get through that, then, and especially if Chinese growth is ramping up, because they've had a bit of a slowdown. If they start to reaccelerate, commodity prices start to go up, and that's a very bullish backdrop for the Canadian dollar. But we just have to wait, I think, into next year for that to play out.
Now, Mark, you mentioned something that everybody wants to talk about pretty much all the time is home prices, interest rates on people's mortgages. Should they be variable or fixed? And we've seen huge price appreciation in real estate in Canada the last decade. Really record amounts. Stock market here, not so much, but definitely real estate. So how does an increasing interest rate in Canada affect real estate prices? Is it something that we can overcome with demographics, with people moving to Canada, or could we see a replay of the 80s?
Yeah, I mean, with the data that I've seen and how loaded up Canadians are with debt, and a lot of them have taken out short-term floating rate loans. Even 100 basis points is going to be very painful for a lot of homeowners. So I think that's another limiting factor for the Bank of Canada. They're going to have to go very, very slowly on hiking rates and just hope that the bubble, if it is a bubble, doesn't burst and take the rest of the economy with it. They have a very delicate balancing act. So I mean, for me, I would say, I mean, they're hoping for a soft landing in housing. That's where house prices stop going up and they just kind of go sideways, and you don't have the big decline. But we know historically that bubbles, if it is a bubble, bubbles do not normally go out with a whimper. They go out with a bang. It's been tried in many countries to get a soft landing. It's very hard to engineer. Usually when a bubble pops, it just goes down hard. So I don't want to I don't want to sound like Mr. Doom today or anything like that, but history is not on our side. The only thing they can do, I think, besides if raising interest rates is going to be too painful for housing, then the only thing really you can do other than that is the macro-prudential adjustments that just make it harder for people to qualify for a loan. They just keep snugging the requirements a little bit at a time, and then perhaps maybe the government will make it harder for foreign investors to come in and buy Canadian housing, and then also what would really help to attain a soft landing is if municipalities would just ease up on the red tape and allow builders to build like crazy. We need supply right now, right? And I don't think there's enough. They haven't been, as far as I can tell, there hasn't been enough discussion about that. There's not enough pressure on municipalities to get to ramp up house building, and try to engineer this the soft landing. If it has to be, if it's not going to be macroprudential or supply, then it's going to be interest rates that ends it, and there I think could be in for some real trouble in Canada.
Now I want to sort of end in today's podcast with a real political hot potato, modern monetary theory, MMT. Everybody seems to have a position on it, but in general, MMT allows the government to borrow indefinitely, almost to any extent, as long as there's faith in that government. What are your own thoughts on MMT? Can we borrow our way to prosperity?
Well, that's the other thing they teach you in Economics 101 is that there's no free lunch. Now, it seems like there has been a bit of a free lunch because central banks have monetized a lot of debt. After the great financial crisis, and they started the QE program, they started buying all these government bonds. But at that time, the idea was, don't worry, it's not going to be inflationary because this is all just showing up on the banking system's balance sheet as excess reserves. We can still control interest rates. Once we get back to normal, we're going to sell those bonds back to the market. So we're not going to increase, the central banks are saying, we're not going to increase our balance sheets on a permanent basis. It's temporary. We're going to reduce them back again. So no long-term inflation consequences from that, right? I don't hear them saying that now. Now we've had the pandemic, cranked up government spending. Central banks have pretty much bought all of this new debt that's been issued. Canada and the U.S. and Europe as well. But central banks aren't really talking about their balance sheet, about shrinking it anymore. So it's like a permanent monetization this time. And I don't believe they'll ever be able to sell it back into the market. There's just no way. It's too much of it now. So central bank balance sheets are huge, and they're going to stay that way. So that means that they have really monetized this debt. So we've spent money that has been created by a central bank. So this is a little bit different from what happened after the GFC. So the risks are higher. Going forward, that eventually we will see higher inflation, and that would be the limiting factor for quantitative easing, and it would prove MMT wrong. So at the crux of MMT, I'm not an expert in that area, but it seems to be that there is a free lunch here, that central banks can just create money at will, and we can spend it, and no problem. So you're creating wealth kind of out of thin air, and there are no negative consequences for that. I don't know, call me old-fashioned, but I can't see it. There has to be consequences down the road. So we've dodged a bullet so far. They've monetized it. We've done the experiment. Let's just hope that they never have to do it again.
So, Joe, I'll let you add the last words for today's podcast.
Yeah, no, nothing to add on MMT.
So it's free lunch for a while until you have to leave the table, go to the cash register and pay, it sounds like. But thank you so much, Mark McClellan, Joseph Abramson. We look forward to everybody again next month. Take care.
My pleasure. Good talking to you, gentlemen.